This week, I'm going to be talking to you about merchandising operations and the differences between a merchandiser and a service provider. So merchandising operations require inventory. Merchandisers are either wholesalers or retailers. They are purchasing inventory from a manufacturer and reselling it to the end user or the consumer. The operating cycle of a merchandising operation is longer than it is for a service operation because the operating cycle consists of the original purchase of inventory from the manufacturer or other vendor, selling that merchandise to a customer, and then collecting payment. So the time from when the merchandise is purchased until the time that you actually collect payment from the end user or the consumer is a lot longer than it is for a company that's just simply providing some type of service to a customer. But when you purchase that asset, that inventory, here's a sentence I have on this screen here. When you purchase an asset, you have an initial outlay of cash, but you do not see the spending of that cash on your income statement because what you have purchased has value. So inventory has a value for you for the purposes of something in the future when you sell that to a customer in order to generate revenue for your business. So this asset has value for you and it will not be consumed at the time you purchase it. So you have two choices when you make a purchase. You either record that purchase as some type of asset, as we're doing here with inventory, or you record it immediately as some type of an expense. Well, it's not appropriate to record the purchase of inventory immediately as an expense because that inventory is not being used right now. It's not being consumed. It's not going to be used until you sell it to the customer. So the expense of the asset occurs as that asset gets consumed. And this is true for other types of assets too, not just inventory. So if you think about fixed assets, which are your furniture and your fixtures in your company, and you hear the term depreciation, which you'll learn about depreciation later on in lessons. The depreciation is how you expense that cash that you have spent to purchase that asset. So as you use those assets, you consume those assets. The consumption of those assets or the using up of those assets is what becomes part of your expenses. So as those assets are getting consumed, and in this case, as we are selling inventory to a customer, we have to remove that inventory from our assets because we no longer have it. We no longer have possession of it. We have sold it. So the cost we originally paid for that inventory becomes what is called your cost of goods sold. And you're going to see that on your income statement. When you start looking at income statements, you'll see revenue minus cost of goods sold equals gross profit. So you deduct that cost of goods sold expense before you deduct any other operating expenses of the company, like the rent and the utilities and the supplies, et cetera, et cetera. So when that asset gets sold to the consumer and you record that cost of goods sold expense, that is when you see the outlay of that cash you spent to buy that inventory on your income statement. And the value of the asset on your balance sheet, because remember, assets are on your balance sheet, gets reduced by the amount of the inventory that you have sold. It's no longer there. That's when you see the spending of the cash that was used to purchase the asset. So I want to go back up here a little bit and talk again about revenues and expenses because I see a lot of confusion in the classroom with my students on how expenses affect equity, in particular how expenses affect equity. So remember, equity is made up of several items. It is investments from your investors or owners of the company. And if you're a public company and you have investors, the investors are the owners. And it is also withdrawals from the owners. So if you are an owner of a private business and you withdraw cash or some other type of asset from the company, that reduces your equity. So these investments into the company increase equity, withdrawals out of the company decrease equity. Dividends paid to investors is also a reduction of your equity because if you're paying a dividend to your investors, it's almost like you're giving them a share of you're giving them a share of the profits that the company has made. So it's like a profit sharing. And the other thing that affects your equity is retained earnings. So at the end of the accounting period, when you add up all of your revenues and all of your expenses, those numbers get rolled up into an account called retained earnings. So it moves from your income statement to your balance sheet. It moves to equity through retained earnings. Retained earnings is all of the revenues and expenses of the company that are accumulated over the life of the business. So at the end of every year, you close out your income statement, you zero it out because you're only tracking your income and expenses from 1 year at a time. So you accumulate all the revenues, all the expenses for the year. At the end of the year, you zero out all those accounts and move that balance, whether it is a net profit or a net loss, into your retained earnings. And you start fresh for the new year with the new year's revenues and expenditures. So revenues, if you remember from prior discussions, revenues are increased with credits. Expenses are increased with debits. So if we go back to the accounting equation, you remember everything on the left side of the equation is increased with a debit and decreased with a credit. So assets increase with debits, decrease with credits. Everything on the right side of the equation, which is anything that makes up liabilities and equity, is the opposite. It is increased with credits, decreased with debits. If you don't have that concept nailed down, go back and watch my video on understanding debits and credits, because that is the key to everything you're going to learn in accounting. You have to get that concept in your mind. So if equity is increased with credits and decreased with debits, then it's a lot easier to understand what is happening as you add revenues and expenses to your equity. Again, revenues are increased with credits. Equity is increased with credits. So as your revenues are going up, your equity is going up. Expenses are increased by debits, but equity is decreased by a debit. So as your expenses are going up, it's causing your equity to be reduced. So expenses are reducing your equity. That doesn't mean that you're reducing your expenses. You're not. You're not reducing expenses. You're increasing expenses. But every increase to an expense is taking away value that you own in a company or in your personal life if you apply this to your personal expenditure. So again, I just want to kind of go through that again for some of you who still may be confused. And hopefully that helps a little bit with your understanding. But now I want to get back again to merchandising operations that we are talking about this week. So back to what I said a second ago, when you are looking at your income statement and you record your revenues and you subtract your cost of goods sold and you get your gross profit, you do that before you deduct any other operating expenses of the company. And there are two types of inventory systems that companies can use. They can use what's called a periodic system, which requires you to physically count the inventory at the end of a period, whether that's a year or a quarter or you do it every month, before you determine how much inventory you still have on hand. And if you look at what you've purchased and subtract out what is still on hand based on those inventory counts, the difference is considered to be your cost of goods sold for that period. The other type of system is a perpetual system. In a perpetual system, you have a computerized system that records the purchases of inventory and the sale of inventory. So it is constantly keeping track of how much you are supposed to have on hand versus how much has been sold as items are being bought and sold into the company. These systems use barcodes and scanning capabilities to maintain the inventory. So if you think about every time you go to Walmart and you check out, or Target, and they scan your items, that is an example of a perpetual inventory scanning system where it is tracking the inventory that is being sold. Now, what can't be accounted for are things like theft and breakage, or items that spoil that have to be thrown away. Those amounts are captured at the time that physical inventory is counted. So just because you're in a perpetual inventory system does not mean you don't have to count the inventory anymore. You still have to count it. You have to make sure that you have on hand what the system says you are supposed to have on hand so that you can track what the differences are and try to attribute those to things that might have been thrown away or spoiled or broken, and also determine how many things you're losing as a result of theft, whether it's employee theft or customer theft. That's a very important tracking system. From time to time, you are also going to offer discounts to your customers, a purchase discount. It could be some type of a discount because they're a good customer and you do business with them a lot, or maybe they're buying an item that has a defect that they want to purchase it anyway, but you're going to give them a discount because it's not quite a perfect item. You also have purchase returns and allowances where a customer may return an item that they decided they didn't need or that was defective and wasn't working. Those amounts are going to be reductions to your revenue. Another important topic, and when we talk about merchandise inventory, is when you're shipping goods to your customers, there are two methods for shipping goods. You have what's called FOB shipping point or FOB destination. FOB stands for free on board. So the shipping point and the destination determine when the title of the goods passes from the buyer to the seller. When you're using FOB shipping point, the title to the goods transfers from the buyer to the seller at the moment the goods are shipped. If you're using FOB destination, the title to the goods does not transfer from the seller to the buyer until the buyer actually receives those goods. The passing of the title of the goods is very important because it determines when the transaction is recorded. So when the title passes, that is when the buyer records those items into their inventory, and when the seller takes them out of their inventory and records that sale on their books. So even if the title is passing at the shipping point and the buyer has not received those goods, they have to go ahead and record them in their inventory because they own those goods even if they're still in transit. Now, another important concept about the freight, when you are buying inventory, the freight charge that you are paying to acquire that inventory becomes part of the cost of the inventory. But when you are selling inventory and you are shipping it to your customer, the cost of the freight out is not part of the cost of your inventory. That is an operating expense. It is not related to inventory. So remember, if you're paying freight to receive goods in, that freight charge becomes part of the cost of the goods. So it becomes part of the inventory value in your assets. If you're paying freight to ship goods out to a customer, that is an operating expense. It is not part of the value of your inventory. All right, I'm going to cut the video off here because I think that's enough discussion for this topic. But if you have questions, if you're one of my students and you have questions in my classroom, please post them in the classroom and let's discuss this further. See y'all soon. Bye.